Yeah.
Good afternoon. Sorry about the slight delay. Welcome. Welcome all of you to this program. As you know, there's a diverse audience of people here, people from brand-comm, people from feedback, people from Madison. And so I'd request you, if you have any questions, please, reach them to us in the chat and we will see that the questions are responded to. Let me start with a small story. Many years ago, we had a quiz group, which is a group of family. It was called a family quiz, and 30 years later, it still continues. It had some very interesting people like Bhaskar Bhatt, Nandan Nilekani, Rekha Menon, and all that. So one of the quizzes was happening in our house, and Mr. Nandan Nilekani, who was then a director in Infosys, came with a battered suitcase in which he brought some Infosys shares and said, if any of you are interested in subscribing to this, please do. So I subscribed simply because Nandan is my friend, and if any of my friends do something, I just have to support it. Some of my other friends didn't do. They talked about things like EPS not being okay and all that stuff. So Infosys, as you probably know, is the best performing stock that we've seen for the last 3 decades. So in my case, it is dumb luck. I mean, there was no other reason that I had the shares. Incidentally, we also handled the public issue. But I thought people like you should get the benefit of some advice, some guidance from a person who's been doing this for many years. So it's my privilege to present Shekhar Vishwanathan, who's a good friend of mine, even if he beats me at bridge and golf occasionally. But what he has is a background in banking and financial services. And for the last 2 decades or so, he's been with the Toyota Group. He's the vice chairman and director, and he's a very popular speaker, quotes on the budget, on CNBC, on major things that are happening in the financial market, etc. So I think young people especially need to get a start in life with finances, and that's the reason why I thought, we should get somebody of his eminence to come and speak to us. So he will probably speak for something like 30 to 35 minutes, and then we'll throw the floor open for questions. Please use his experience and wisdom to ask any questions that you may want to know about building your own financial portfolio. So, Shekhar, the floor is yours, please.
Thank you, Sridhar, for that introduction. I don't know whether I'm going to be able to do justice to the expectations of all of you. One, because this is the first time I'm kind of presenting to an audience that I really can't see.
Yeah.
And so this is a new one for me.
This is the new normal.
This is the new normal.
Yeah.
Earlier I could at least make eye contact. I could make out from the body language whether they were liking my talk, not liking my talk, getting bored. If there were a couple of people yawning, then I know I had to wind up quickly. But I have no such advantage in today's presentation. And neither do you have that advantage. So you've got to suffer me for the next 30 minutes. What I would like to do over the next 30 minutes is to take you through some of the better known financial instruments or asset classes, as it were. And then I'll give some words of wisdom and some home truths, etc., which I hope will stand you all in good stead. Most of it you people may know, but it always is good to kind of hear somebody else say it and then revalidate your own thinking on the subject. Patricia, can we go to the next slide? Now, I've deliberately titled this Creep and Scrounge because in the initial years of my career, and indeed the careers of most people, we are, this is the first flush of salary that you get, and then the first 3 months is heavenly because you never had so much cash in your pocket. But then as time goes by, you tend to scrape and scrounge simply because you can't afford everything that you want to be able to afford. But time will progress, and so will your income levels. And some of us will be lucky to get some income from our inherited assets or from assets that our parents may give us or a rich uncle or aunt may leave us. Most of us have to depend on the salary income to support our families. In fact, I do remember in my younger age, I had to send money home. Now, some of us may still be doing that. Some of us may not have to do that, but yet have to manage with what we get. But most importantly, some of us may inherit wealth in the form of shares, cash, fixed deposits, property, etc. So whether we earn a salary or whether we inherit assets or whether we have to make do with whatever assets we have and then generate some income from it, it is our responsibility to manage them. And I think this is the central point that I want to make in this slide. Next slide, please. I'm, of course, making the assumption that most of you in the audience here depend on your salary income. While you have the comfort that you will inherit some assets at some point in time. So my talk is going to be structured more on how to manage assets as we go along. Your needs constantly change. When you're single, the changes happen. And then you develop attachments, and you know the kind of attachments I'm talking about. And at that point in time, you begin to experience a greater budget constraint on your salary, etc., with your salary not being sufficient, etc. And when you make those attachments permanent, then of course there's an entire new dynamic that comes into place. You have to live with your partner. You have to not only make do with the salary you get, you look at ways to borrow money to either invest in a fixed asset or in property, or you have to buy some of the more fundamental things in life like your washing machine, a car maybe, or a two-wheeler, or whatever else. The important point here to note is that your needs constantly change and they keep increasing. But what is the difference between now and 30 years ago in the context of managing your finances? 30 years ago, I remember there were no ATMs. There was only a teller, and you had a queue in front of the teller. You first had to go submit your passbook. The clerk at the counter will say, okay, now you come to the teller, this is your token number. Then you waited for your token number to appear. And then you went to the teller and collected your cash. Now you can see how easy it is to operate an ATM. And if there's no cash in the ATM, we end up cursing the banking system. You also updated your passbooks with the clerk making entries manually. And if he did make a mistake, you gave him hell, or he refused to acknowledge his mistake. And then he will tell you sometimes, you come back next time, I'll correct it. So, so it's a combination of all of these things that happen. But today you don't have to do anything of that. You just go to a net banking facility, look up your account, and there it is, no errors whatsoever. If at all there was an error, which is always on the debit side, never on the credit side, you complained, and then of course, if really there was an error, which is the 1 in a million chance, you would get it corrected, or the bank itself would unilaterally correct it. There were no credit cards in those days, and therefore credit cards, so you didn't have the luxury of postponing your actual cash outflows. Today you have credit cards. I still remember the time when I went to Hong Kong as part of my bank program, every other nationality who was doing the credit training program with me, they were all carrying credit cards and they would spend money. And I was the only one, and we would take turns in buying each other meals. And I was the only one who had to hurry to an ATM in Hong Kong, draw cash, and then make sure when the bill came that I paid by cash. Such was the situation then. I think today it's very, very different. And of course, if you wanted to make an investment, you had to manually fill up the application. Today, you have pre-populated investment forms. The reason I'm mentioning all of this is to tell you how much more convenient it is today to manage your finances. And I think with all the internet banking and other electronic banking facilities that we have today, life is a lot easier. Next slide, please. Some home truths. Now, in your investment exercise, or when you try and save money, don't look for a fortune teller with the perfect record of telling you where to invest your money. I mean, that's not going to get you anywhere. Or if you do one better than that, if you want to rely on advisors whose motivations conflict with yours, you're not going to do any good to yourself either. The third point, and I think this is very, very important, how much to invest in equity, how much to invest in fixed deposits, how much to invest in gold, how much to invest in property is something you'll never be able to guess. Nor is there a scientific system that will signal to you at every turn of the market that this is the perfect system to go with. The point I'm trying to make here is there is a lot of guesswork, educated guesswork, that you will have to do with every change in perception of the economy, with every turn in the marketplace. Sometimes gold will be the flavor of the season. Sometimes it'll be property. There will be people telling you war stories of how they bought a flat for 10 lakh rupees and how they sold it in 3 years' time for 25 lakh rupees, and now how much more richer they are. But the guys who won't tell you any such stories are the ones who bought something for 10 lakhs and 3 years later, they've just had like 3 potential buyers visit them and no repeat calls. Nobody tells you a sob story. Everybody tells you a success story. So the point is, you won't have a scientific system, but you will have a basis for making your economic decisions. And that basis is your own position with regard to your finances, which is why you must always stay on top of the situation. A couple of more things. Don't get, particularly in the context of the equity share markets, don't get carried away with fundamental or technical analysis. It's very good up to a point, or it's good beyond a point, but it's for you to judge. Ultimately, you're the judge. It's your money. You have to take the call. Finally, of course, there are people who know that they have to send money home, who know that there is an upcoming medical emergency in the family, yet would bet their money in the hope that they will be able to increase it by 1.5 times, and then find that they don't have that money, and then they are borrowing that money to meet that medical emergency or financial necessity. So that's the short point of this slide. I'd now like to focus a little bit on the different forms of investment. I mentioned to you that historically, real estate has been thought of as the best form of investment, simply because you hear all these good stories about how people have seen their wealth appreciate from making an investment of, let's say, 50 lakhs, and today they will tell you it is worth 10 crores. But if they go to the market to actually cash that 10 crores, they would find that that money is worth only 6 crores or 7 crores. Now, similarly is the case when you want to encash an asset, you find that you're unable to do so at the point in time when you want the money the most. So real estate, the merit is that it's always generally appreciated in value. It's a good store of wealth because land values being scarce, they've always gone up. And the popular feeling was that you never lost money, and that there was always, particularly in a place like Mumbai, there was always a demand for flats. There was always a demand across India for land, and many a family battle was waged over which brother would get the land rights and which brother would get other assets of the family. So these are all realities, but the merit of real estate is it never lost value. But to encash that value, you had to wait for a long time. The demerits, therefore, was you had to be, property had to be always actively managed. If you left land as it is, there was always the danger that squatters would come and occupy your land. And then to get them to evict the land, you had to spend a lot of money. So you either had to fence it, in which case you had to spend some money. But generally, my feeling was unless you actually occupied the property, there was no guarantee that that property would be yours as time went by. And would you concentrate on your career and in earning your money and earning your bonuses? Or will you be worried about uncle or a well-meaning father left for you? The other demerit about real estate is proving title and ensuring that you always got good title was always a bit suspect. There is no title insurance in our country as yet, meaning, insurance companies overseas do have this practice where they will insure your title to the property for a sum of money. In India, this concept has not yet evolved. I am told that there are some insurance companies who are at the beginning stage of offering this financial product, where if you pay a little premium, they will tell the prospective buyer that this person has good title, and if the title was ever proven defective, they would make good the money. But this aspect of the property market is yet to develop in our country. But when it does develop, let me tell you, it will prove to be a boon for most of us who have land or buildings or a flat where you can say without fear or favor to an intending buyer, listen, this has got title insurance. You don't have to worry about anything else. And then, of course, the demerit about flats and land and all that is it's the most illiquid asset. It's a very lumpy asset. If you had a property worth 2 crores and you wanted like 50 lakhs, you can't sell 1/4 of that to realize money. So therefore, you had to do what you had to do, sell the entire thing, and then hopefully you will manage with the 1.5 crores in buying another asset. Next slide, please. Gold as a form of investment. It is an excellent store of wealth mechanism. It's an excellent store of wealth mechanism. You can always store it easily in a locker. Today, there are financial products that are indexed to the value of gold. If gold prices go up, the value of the paper that it represents also goes up. You're able to trade it immediately and realize cash. Physical gold is always more difficult to maintain, but locker operations is one way out. I haven't heard of too many families in the last 20, 30 years wanting to encash their gold simply to repay their debt. Yes, they have to come and told me that they want to sell their shares, they want to sell property, but or if their business has gone bad, they will want to sell some little bit of jewelry here and there, but that's about it. But selling gold is a sign of insolvency, and it also carries with it a stigmatized reputation. And therefore, cashing your gold is not the done thing in India, at least. But I guess times will change, and that stigma won't hold, and people will be then sharp enough to recognize that it's another asset class, and whether what you want to do with it is your business, and your reputation need not be sullied simply because you sell your gold. As an aside, India pledged its gold on a countrywide basis when we ran out of foreign exchange way back in 1991. Many of you may not know that, but we did put this gold with the Union Bank of Switzerland. And in return, we got a lot of foreign currency with which we were able to buy oil to keep our economy going. And then, of course, the country liberalized under our able Prime Minister, Mr. Narasimha Rao, and then the rest is history. And we are today a country that is sitting on $500 billion worth of foreign exchange reserves. Incidentally, that gold, which was a pledge to the Union Bank of Switzerland, was brought back to India. And I think Indians did themselves a lot of credit compared to the Latin American countries, which prefer to declare bankruptcy, whereas India did not. And I think it's testimony to Indians not wanting to, at any time, show any kind of insolvency. Today's paper financial products do earn interest, and I think this is something that I would urge many of you to read up on. Next slide. Yeah, why are investing in shares so fulfilling, yet considered risky? First of all, it's highly liquid for many listed shares. If it's an unlisted share, it's not liquid, and then you'll have the same problem in finding a buyer. Some listed shares are illiquid only because the company that they represent has gone bankrupt, and therefore you won't be able to sell your shares. I don't know whether any of you had Yes Bank shares in the recent past. You would have had a difficult time selling them. And today, of course, they've been brought back onto the market, but then they're quoting at 25 rupees. And for those of you, or for those unlucky ones who had bought it at 400 and 500, they would have had to take a big bath. The other big merit today is information on individual companies, on industries, and on the economy is today easily available. And therefore, if you have the time, and if you have the energy, and if you have the mental wherewithal, you can do a lot of your own research into these companies and check for yourself whether you've made the right investments. Now, some people are fearful of making the right judgment. Some people say, I don't know how to read a balance sheet. But this much, I think all of us can credit ourselves with, that over time, we can assimilate a lot of knowledge about particular industries. You know, for instance, I know nothing about the infotech industry. I mean, I knew that Infosys shares was being listed way back in 93, 94, if I recall right. And I said, I don't know anything about this company. I will not invest in it. And the only good investment I made was in HDFC Bank shares, where I invested 300 shares only because I knew a little bit about banking. So the first thing that I would like to tell all of you is, please have faith in yourself. But if you have not done the necessary reading, don't invest in shares. Then where you should invest your money is something we can discuss separately. But unless you are convinced about a company, or at least have some background information on the company and have done some reading, don't invest. The high degree of automation at stock exchanges has certainly helped the cause of those who want to invest in shares. I still remember way back in the 80s, particularly, before the advent of the National Stock Exchange and before technology became so pervasive, we had to deliver shares and receive shares by way of paper transfers. There was a paper script and there was a paper share transfer deed. And very often, or more often than not, I mean, that's more accurate to say. You would send the shares for registration with the registrar of the particular company, and he would say signature differs. And then the shares would get returned, by which time you would have paid your broker, the broker would have paid the exchange would have paid the selling broker, the selling broker would have paid the seller of the shares, and the seller of the shares would have disappeared. You would get what we call in technical parlance a bad delivery, and you wouldn't be able to make good on those shares. Yes, you could complain, etc., etc. In some cases, it did get resolved, but a large number of cases, it did not get resolved. But today, let me tell you, the specter of bad deliveries is behind us. The stock exchange, in fact, this is one of the things that the government of India must credit themselves with. Today, we have a transparent, functioning, active share market and stock market, both in the form of and the fact that the National Stock Exchange came on so effectively meant that the Bombay Stock Exchange, which is the other premier stock exchange, had to reform quite a lot. And today we have a very vibrant capital market, a secondary capital market that is very active, and that's also paved the way for a good primary market to be there. In terms of demerit, sudden falls in price can happen owing to company issues, like it happened in Yes Bank, or like it happened in Kingfisher Airlines. It can happen due to industry issues, where a particular industry is suddenly swamped with, it can happen to the pharmaceutical industry as a class. It can happen to the automobile industry as a class. For instance, when diesel vehicles were banned, suddenly we found the share market marking down the prices of all the car companies. Or when a black swan event happens, like the current pandemic. I think this is too recent in our memory for me to elaborate on this. I think you've all experienced it, and therefore I won't dwell too much on it. Next slide, please. Now, if you feel you don't have the time or the expertise or the patience to wade through thick annual reports or to read up, and you'd rather give your money to somebody else to manage, please do. But please understand, whether you invest in a mutual fund or whether you invest in a portfolio management scheme, you are at the mercy of the fund manager. More so in the case of a portfolio management scheme than in the case of a mutual fund. In the case of mutual funds, what happens is you could buy your fund manager could buy 5 very good shares, but he could also buy 6 dud shares. And this will all get reflected in one composite number called the net asset value. And that may then get marked down significantly, despite those 5 good shares doing very well. In the portfolio management scheme, I think the fund manager has a little more flexibility because he focuses on your portfolio or on the class of portfolios. For example, if you've invested 25 lakh rupees, then he has a chance to kind of tailor make your portfolio to yield good returns. It gives him a better level of control, but it doesn't give you any control. And you can at least see the kind of shares he's bought and and what prices he has sold. And the cost, the sale price, it's good that the share is going at. And therefore, to that extent, a PMS is a better mechanism. But remember this, you're at the mercy of the fund manager, and how you select your fund manager is very, very important. Next slide. Now, before I go into some of the fixed return instruments, I don't know how many of you have heard of Naval Ravikant. He's an angel investor. And one of the things that he has said is, all the benefits in life come from compound interest. How you compound your interest in relationships, in money, in habits, anything of importance. And I think the concept of compound interest is at the center of the various fixed rate instruments that I will shortly describe. Next slide, please. Charlie Munger, again, is a well-known investor and I think compatriot of Warren Buffett. The first rule of compounding is never interrupt it unnecessarily. So the moment you take out money from an instrument that is compounding your money, you're only hurting yourself. And the power of compounding, you will only realize when you sit either with an Excel spreadsheet or with paper and pencil and find out for yourself how much your money will be worth in 3 months' time, in 6 months' time, and in 5 years' time, and in 10 years' time. It will take some doing, but it'll be worth it because then you will truly understand what the power of compounding is and why you should not interrupt it. The fixed return investments are fixed deposit with banks, with non-banking financial companies. The reason why people put their money with non-banking financial companies is you tend to get a better rate of return. Annuity policies with insurance companies is another mode. But the best power of compounding is with public provident funds. I presume that all of you have opened a public provident fund already, because I think the maximum you can invest per year is 1,50,000 rupees. I remember in my initial years, I was not able to find that much money. So I would invest smaller sums of money, but I had made it a habit over the years to keep investing every month something. And then it got to a stage where every year I would put in 1,50,000 rupees, and you can withdraw this money at the end of 15 years, where you will get a huge sum of about 20-25 lakhs. And this is very good because without your realizing it, this snowballs into a big amount. The younger you are, the better it is, and the earlier you must start. Similarly with post office saving schemes, but I won't dwell on it because I personally have never invested too much or have hardly invested in post office saving schemes. So I will let it rest at that. I will now talk about some good habits while investing, and then I will stop. First of all, diversify your portfolio, but don't over diversify. I think if you're investing in shares, focus on 7 to 10 good shares so that you have an idea of where you're investing. Do your research, and I spoke about this. The internet is full of good material on every industry. Company websites are an excellent source of information. I mean, for example, if you went to the HDFC website and just read their take on the housing finance industry, you will get a very good idea of what the housing finance industry is all about and why people save with HDFC so much and why people turn to HDFC for their loans. The third point I want to make is it's okay to burn money once in a while. When you're young, you will burn money, but never burn your capital. Set aside your capital and protect your capital with all your might. Or your borrowings, never burn your borrowings. Your borrowings have to be purposefully used. And when I say burn your money once in a while, when you're young, you will spend it. You will take that holiday. You will go on that or you will take that flight that you perhaps don't have to take to another city to be with your friends. So one of the things that I like to din into youngsters is it's okay to burn money once in a while, but don't burn your capital or your borrowings. It's very important to regularly check your bank statement and credit card statement. There's a lot of discipline in doing this. You must set aside a Sunday or a day in a month at least where you check it. Today, of course, it's very easy for you to check it. Every time you go to the ATM to withdraw, you can get a bank printout so you can quickly check it and make a note. Check your credit card statement. Just the act of checking it will set you thinking about whether you're overspending or not spending enough. So it'll give you an idea. One thing about real estate is check all the documentation, your title deeds, your khatha. When you go to sell a property, the buyer will ask for things that you'd never heard of before. So you should know exactly what you have as apart from the title deed, which is a must, and the khatha. There could be other things like your property tax receipts, your water bills, your electricity bills, and any other document that your lawyer may advise you. And if you have a flat in a cooperative society, you may need to have proof that you've paid all your dues. Remember that an intending buyer would like to deal with an intending seller where the documentation is all near perfect or perfect. An encumbrance certificate, for instance. Of course, an encumbrance certificate you can't kind of apply and keep, because this needs to get refreshed every 3 months, because that's what an intending buyer would like to check. Avoid taking any personal loans, because personal loans tend to be of very high interest rates. And my personal experience is it's best to avoid it. But if you have to take it, do take it, but make sure that you repay it. As in business, in personal life too, cash flow is everything. And finally, I'd like to conclude by saying, above all, in all financial matters, we need to be utterly disciplined. Discipline is the essence of our living, and is the essence of good investing and the pathway to a very peaceful life. With this, let me conclude. I think I've spoken far longer than I intended to, but I may have taken a good 35 minutes. So now I will leave it to the floor for questions.
Thanks, Shekhar. Just quick sort of comment or question, the way you want to see it, is many people think that, next year I will get a raise and I will get more money. So I will, start saving from next year. The thing is, you're always thinking that you don't have enough money to start the process. So do you have any thoughts on when is a good time to start doing this?
Yesterday.
Yeah.
The best time to start saving is yesterday, but if you haven't done it yesterday, you better do it today. I believe me, I think Sridhar, you and I know it, that in our younger days, we just about managed. But I think, making it a habit is about the best way you will cultivate of just saving some money.
Yeah.
You have to send some money home, but over and above that, even if it's $100, I used to be motivated enough to save it just for the rainy day.
I think younger people have a slightly different perspective on life.
Oh, I'm perfectly willing to understand and accept that. I can only boot off of my experience. Sure. See, the saving can come in any form. It can be in the form of a simple recurring deposit, which may today be not in vogue, but it can also be in the form of some amount of equity.
Yeah,
that can also be a form of saving.
Yeah, so you actually led me to what I wanted to ask. So there's a lot of talk about mutual funds. We see a lot of advertising for mutual funds, and there are people who say that if you put in an SIP, however small, that over a period of time, it can be quite beneficial. So can you talk us through that?
Yeah, with the mutual funds, I myself have had mixed experience. Some of the funds I've invested have done very well. Some of the funds that I've invested have done very badly. And therefore, you need to be very, very careful about as to which fund you're going to be choosing. Now, even if you're careful, it may end up coming a cropper. But I would think that an SIP, a systematic investment plan into mutual funds, is probably the best way to hedge your bets. Even if you put aside 5,000 rupees, 10,000 rupees a month, through an SIP route into mutual funds, it's still very, very advisable. Now, your net asset value may well end up that at the end of a year, you may have to encash the units in a mutual fund at a loss.
Yeah.
But that's okay. But that loss is at a weighted average that you've made through the year, and it probably mirrors the market conditions.
Sure.
And therefore, the loss hopefully won't be too severe. And then you can take that money and maybe, by then your financial position is improved. And then maybe you can put it into individual shares, maybe 2 or 3 shares to begin with, and then gradually expand your portfolio.
Yeah. So again, whilst we are on the share business, probably, everybody talks about taking a big risk with some small caps and they might make a killing. Everybody talks only about the money they make. Nobody talks about the losses, as you rightly said. So as if I had a limited amount of money and let's say I had to do it in equity, what would your advice be?
See, I have a big reservation against small cap companies.
Yeah.
The reason being that small cap companies typically aren't favored by the general market. Now, despite all the strictures imposed by SEBI is the Securities Exchange Board of India, and by the stock exchanges, there are a number of small companies out there which are actually dud companies.
Okay.
And, if you have not done your research properly, or if you have made a mistake, you could well be sinking your money into a dud company and then watching it just evaporate. And over time, it can even get delisted. Now, with the bigger companies, the large cap companies, the protection that you have is that typically the Group A securities, as we call them, the Nifty 50, as I would prefer to call them today,
Sure.
They typically don't go down in value. Typically, again, there are exceptions to the rule, but you'll generally find that they tend to appreciate, and you need to get the confidence that you can play the stock market effectively with a few victories under your belt.
Yeah.
Now, if you invest in Ashok Leyland, which is today not doing too well, and your investment at 50 rupees jumps to 53, and you make 3 rupees on 1,000 rupees and make only 3,000 rupees, it at least gives you the confidence that you can make money on the market. But if you invest in an XYZ company, which is a small cap, and the share price doesn't move at all, you're stuck with it. And then when you need the money and then you see some other attractive opportunity, and you're not able to move in and out, then you're truly stuck.
Yeah.
So my advice would be, don't go for small cap, go for proven mid cap or large cap.
Large cap.
Yeah.
Even if they seem expensive at some point of time.
Correct.
Yeah.
I mean, I'm not asking you to go for a Nestle, which is today at 16,000 rupees or 17,000 today.
Even if you ask me, I can't.
But the point is, go for large cap.
Other question is, people talk about timing the market and all that. Do you think people like us can do that?
I don't think. Show me somebody who says he's timed the market well, and I'll show you a liar.
Yeah, I think that's true.
Nobody times the market. I mean, people get a general sense of the direction of the market, and they can probably sell when it's when it's ascending. You'll never catch the peak. You will always sell at a low, but you'll never be selling at the lowest either. So I think that's the reality of life, and I think young people must understand this. There is no such thing as, I think one of my points I had made, don't rely on fortune tellers.
That's true. Are there any comments, questions? Patricia, is there anybody who wants? I can see Sam. Hi, Sam. Sam, unmute yourself. Pat, can you unmute Sam?
Yeah, I'll mute. I'll mute.
Yeah. So very good advice, Shekhar. I joined it a bit late. Actually, I thought you were going to talk about how to manage Madison's finances.
I don't think I worked in the
No, but
advertising
now
industries.
that's a very good advice. I must say, I am so how much do you rely on professional portfolio managers?
Okay. Can I answer that now?
Yes.
Okay. I personally don't rely on
Oh,
professional.
sorry, you can't hear me?
Yeah, he heard you. He heard you.
No, I heard you.
Yes.
You can hear me, right?
Okay.
Mr. Balsara,
we
you can
heard
hear
you.
me? Yeah. Okay.
Yeah, you, yes.
I don't rely on professional managers at all. I do take bits and bobs of advice that keep coming, but that is perhaps because I have had the good fortune to begin my career actually with the Unit Trust of India, and which was the premier investment firm in mutual and started the mutual fund industry in India. So I've had that background, and over time I have built up a lot of expertise in this field. But I do. But one thing I always check myself. I keep reminding myself that you can't know everything. So I do keep talking to fund managers. I keep talking to professional managers for their views, but I make my own decisions.
Yeah. I remember once I was traveling with Deepak Parekh on a flight, and over a long 1 hour or so, we got down to talking. So he told me that, look, when it comes to advertising, I don't do it myself. I rely on a professional like you. So when it comes to your investing your money, you should rely on another professional like you in the finance area, not try to do it yourself.
Well, we are talking here about personal finances. So
personal finances.
Yeah. So as far as personal finances go, my view is that everybody has to look out for himself. You have to manage, you have to take that responsibility. Yes, you take professional advice, but you make the decisions. If you leave it to the professional managers, it's to me, it seems a bit like abdication of responsibility. If you don't know, educate yourself and play safe always. That's my philosophy, Mr. Balsara.
Yeah, very true.
But that's Sam, that's why he's a rich man. So Shekhar, there are a couple of questions.
Yeah, sure.
What is the ideal saving to spend ratio? Is there anything like that?
Oh, okay. This is something that's, one day I tried to plot my own savings to income ratio.
Yeah.
Needless to say that in the initial years of my career, from 1981 through almost 1995, the ratio was, my expenses to my income was about 95%. So I saved very little.
Okay.
For various reasons. My real savings started from 1995. Okay. And then the percentage started dropping. So then it came down to 90, 80. Today, I'm in that happy position where it's where my expenditure is just 5% of my total income or 10% of my total income, depending on what you consider as expenditure. So, so I suspect that for most youngsters, it would be at a very high percentage in their initial years, and thereafter it will, that percentage will keep improving. It'll go from 95 to 90 to 80 to 70. And there will come a stage when it will decisively drop below 25.
Yeah.
And after that, it's a function of how well your investments have done, how well your continuity, your employment, factors like how the economy itself is doing, and whether you've had one big real estate deal that can change your fortunes, or a multi-bagger like Infosys that can change somebody's fortunes. I know of people who bought Infosys and they've been able to sell it and build houses with it, with the proceeds. So one event can change your life and can change this percentage drastically.
Yeah. So there's one more question. Given the current pandemic, is investment a safe bet now, you think?
I do think, for the people who've got the ability to bear risk, that is, if you don't have any borrowings, if you've not applied for any moratorium, if your existing investments have appreciated, then I think you can go into the equity market at this point in time or start getting going. But even today, I would apply a strict 50-50 rule. Let at best, at maximum, put 50% of your earnings in a month into equity, and 50% let it go into fixed rate instruments. The more ideal condition would be 75 into fixed rate and 25 into equity, and that too equity that and you've got to be very choosy there. People who make consumer goods will find demand recovering the fastest. So go into those scripts if you can, but otherwise just stick with fixed rate instruments.
Yeah. So there's another question. At a younger age, would you suggest starting off with mutual funds before dipping into the equity market?
Yes, I think starting with mutual funds is always advisable. And I would advise the SIP mode, because you're not putting all your money into one mutual fund, or you're not putting a bulk amount. You can put it gradually. And then I think the SIP also offers you an option to stop if you think that the net asset value of the fund is dipping sharply.
Yeah. So you would think SIP is a good option?
Is the good option, at the start.
So there's a lot of talk about gold bonds. What is your view on that?
Oh, I think today, gold prices have already gone up. So probably the time to invest in gold was 1 year or 2 years ago.
Not now.
Well, there's a lot of debate going on in gold. See, the popular perception about gold is it's a safe haven instrument. Let's say nuclear war were to break out, everybody would go for gold, and gold would appreciate. At that time, forget about shares, forget about bank stocks, forget about fixed rate instruments. It'll be gold, maybe silver to some extent, but that will be the way to go. You must always have a certain percentage of gold in your portfolio. What I would advise is about 5%, but you do have the freedom to up it to 10%, particularly because you get a 2.5% return on gold today. It's not a dead investment like it used to be in the past.
Right. Thanks, Shekhar. It's been really useful for me, at least, and I'm sure it's useful for all the people. We had a surprise visitor also in Sam Balsara. So I just wanted to, make a few points in summary to what Shekhar said. I think it's important for you not to abdicate this particular aspect of your life, in the sense that look at all the information that you can get. Thankfully, today in the net, you have a whole lot of information. But being in the media business, we know that some of it is biased. So you have to use your discretion. The second thing is there is no great time to start investing. You're not going to wait for your next increment or your next, windfall for you to start investing. I think what Shekhar said was very relevant, that, yesterday is as good a time as any to invest in. And you're never too young to start investing. See, we did not have the good fortune that some of you had. I just repeat this. When I was, and Shekhar did give the example of how he sent home money, and I used to do this for many years. Thankfully, my children don't have to do that. So basically, I'm sure many of you are in that happy state where your parents may be still working or don't need your support financially. So that gives you an opportunity to start thinking about your own future, your own finances. Shekhar spoke about attachments happening in your life. So many of you are probably unmarried as we speak now, but you might have to take additional responsibilities, and then, it'll be a good thing if you started out young. So take this opportunity to understand more about finances, to look at what are the options that you can do prudently, as Shekhar said. And I'm sure in 5 or 10 years' time, many of you will be giving lectures to some others on how to manage your finances. So once again, thank you, Shekhar, for being with us. Thank you all for being part of this. And if there are any more questions that you could not ask, please feel free to share it with me or Patricia. We will get Shekhar to respond to them. Thank you very much. Thanks once again, Shekhar. Thank you for your time.
You're most welcome, Sridhar. Pity that I can't see the audience, but anyway, I'm sure better times.
So they saw you and heard you well.
Yeah.
Okay.
Take care. Take care, all of you. Good luck to all of you.
Thank you. Thank you, Yashoda.
Thank you, sir. Yeah.